Hi, everybody, and welcome to A Climate Crisis in Insurance Markets, hosted by the Wharton Risk Center on Insurance and Climate Change. I'm Nancy Watkins, and I'm very grateful to Carolyn Kuski and Wharton for inviting us here today. I'm an actuary and a principal with Milliman. I manage a practice in San Francisco and lead the Milliman Climate Resilience Initiative. And my job today is to be your moderator and help you understand, along with our great panel, why insurance markets fail, examples of insurance markets under threat, in part due to climate change, some challenges for regulators, legislators, the business, and the public, and then some policy proposals that we think would be of interest to you all. Today, we've got a 1-hour session. We're planning, we've got plenty of content to fill the hour, but if you have questions, please put them in the Q&A, and we will keep an eye on that for things that we might want to address as part of our panel. So I guess where we're going to start today is just kicking off the crisis in insurance markets, the whole topic of what makes a risk or a market uninsurable. So I'm going to give you just a few fundamentals. Insurance is the promise to pay uncertain losses in return for certain premiums. And that's what we call risk transfer. So if you transfer the risk through insurance, you don't actually need to understand the risk or measure it yourself. You just need to budget for the premium. In our society, economic forecasts and the decisions of real estate investors, lenders, and individuals assume that the long-term insurance market is going to be stable and sustainable. When you're assuming those things, you're really relying on three interrelated concepts. The first is availability. There's going to be enough private insurers and reinsurers who are willing to accept the risk of insuring homeowners in a market. The second is affordability, and that's that homeowners and property owners are going to be willing and able to pay the premiums that are charged in order to transfer that risk. And then the third is reliability, that the insurance companies who take on this risk are going to manage it properly in order to be solvent and stick around and able to pay the claims in case of an event. So today we're going to start with our panelists, and we're going to each introduce ourselves and talk about how our work touches on threats posed by climate change to the sustainability of insurance. And then after that, we're going to delve into the individual components that we just laid out. So I'd like to start with Patty. Patty Bourne from Florida State University. Patty, can you introduce yourself?
Yeah, sure. Patty Bourne. I'm a professor at Florida State University, where I teach in the Dr. William T. Hold National Alliance Program in Risk Management Insurance. I've conducted research on the U.S. homeowners and commercial property and insurance markets, with emphasis on how insurers have been affected and how they've responded to large natural disaster events. My objective has been to try to identify the successful strategies for bearing catastrophic risks. That is, I'm looking for the types of activities that increase the likelihood that insurers stay in a market where the exposure to catastrophic losses may be increasing. A sustainable private insurance market for property risks requires a regulatory environment that allows or even promotes enough flexibility for insurers to respond quickly and sufficiently to climate threats. And consideration of rate filing processes is even more urgent in light of the threats that are posed by climate change.
Thanks, Patty. That's going to be a lot to chew on today. Next, Kelly, can you talk about how your work at Liberty Mutual plays into this topic?
Sure. Hi, I'm Kelly Hereid. I'm the head of catastrophe research and development at Liberty Mutual, which means that my job is to take apart the biggest and ugliest physical disasters that we work on in the insurance industry. And my background is actually in climate science, which gives me a really good position to be able to think about how climate change may affect the broader industry. And really what we've learned is that climate change is really an all hands on deck problem. You know, the insurance industry really has a crucial role to play in mitigating the effects of changes in natural disasters that not only are coming down the road, but they're already here. But we're clearly realizing that we can't do this on our own. You know, we saw after the massive power outages and the corresponding damage that came from the Texas freeze earlier this year, that the insurance industry functionally ends up holding the bill from decades of underinvestment in infrastructure that didn't properly account for weather-driven risk. So right now, we're really excited because there's really a once-in-a-generation opportunity to invest in our infrastructure and economy and to get them ready for the climate of the future. So I really hope that when we do this series again in 2050 and get ourselves back together to talk about climate and insurance, we don't spend the whole time wishing that back in 2021, we didn't have a big missed opportunity. Really investing in us as a society in preparing for the risks that we know are coming is a way to make sure that we'll have strong communities and a sustainable insurance market for decades to come.
Thanks, Kelly. I appreciate your great intro. Lloyd, would you like to go next?
Sure. Good afternoon, everybody. I'm Lloyd Dixon. I'm an economist at RAND, located in Santa Monica, and I'm director of RAND's Feinberg Center for Catastrophic Risk Management and Compensation. And so, my work, two aspects that are relevant today in particular are, first, we've done a lot of work looking at the roles of the public and private sectors in addressing difficult to insure risks. So, for example, when is some kind of public program such as the TRIA program, the Terrorism Risk Insurance Program, necessary, and other types of government public-private partnerships. Second, relevant to discussion today, we've looked at the tensions between risk-based rates and affordability, and potential designs for programs targeting those least able to afford risk-based rates.
Thank you, Lloyd. We're having a little technical difficulty with Brian's connection. So when he gets on, Brian Powell from the Alabama Department of Insurance will introduce him as well. But I think in the meantime, we are going to move on to our first question. And it's really going to be focusing on availability. As someone who works for the insurance industry, I have a view that insurers have to be able to manage and measure the risk being transferred in order to make insurance available. Like, for example, flood insurance seemed like it was a risk that couldn't be measured properly back in the 60s. And so the whole insurance market pulled out of it. Hurricane Andrew, same thing. Hurricane risk in the 90s seemed uninsurable. And now we're kind of wondering if California is going to go the same way with our wildfire risk. So Kelly, can you talk about how climate change plays into the concept of risk measurement and availability?
Yeah, thanks. I sit in really kind of a unique position here at Liberty as someone with a sort of a traditional science background who sits in the insurance sector, which means I kind of have a foot in both worlds and serve as something like a climate translator to take this really active body of climate literature, including, but certainly not limited to, the IPCC report that just came out earlier this week, and translating that into metrics that can be relevant for business decision making, seeing what the impacts can be on our distribution of losses over time. So the fundamental problem is that we have, two different ways of looking at physical hazards. Insurers typically use tools called catastrophe models, which are designed to be a snapshot of risk in time that can look at a full distribution of the types of risks that allows us to capture extreme low frequency events. Like I said, I deal with the biggest, ugliest, meanest disasters that we get. On the other hand, climate models are really designed to look at sort of long-term changes over broad spatial scales and look at changes in average conditions. The problem is now we're asking those climate models to come back and inform our CAT models, which are designed to tell us what's going to happen for this underwriting year. They're designed to look down to the level of even individual buildings and look at changes in extremes, which means that you're trying to take tools that were designed for one purpose and ask them to solve other problems. Now, that's not to say that there isn't some low-hanging fruit where we can, really robustly incorporate climate risk into our view of risk today. A really good example of that is sea level rise. So sea level rise is already happening. There's a lot that's already happened. We've got more coming down the road. We know the direction that that's going to go, which is up. And we have really clear impacts on some of our major catastrophic perils like hurricane, because every hurricane that produces a damaging storm surge, that storm surge will sit on top of a higher platform of higher sea levels. We incorporate that into our risk models by not looking at historical storm surges to say what amount of damage would they cause, but rather to say, what would that storm surge cause if it were to happen today? using current sea levels, right? So there are some very clear climate impacts that we're able to incorporate. That being said, we need to understand not only where that science is really robust, but also where that science is still developing, and know that in the insurance industry, we're sitting on sort of the frontier of climate science. I think we've all kind of come to realize, particularly in the last year or two, there's been a really active discussion in the climate science community that, you know, we knew that this was coming. We knew the temperatures were going to increase, but I don't think it had really viscerally sunk in what that would mean for our experience of changes in extreme events. We've seen incredibly intense wildfires. It's pushing 100 degrees here in Philly today. We just didn't viscerally get that even small changes in average conditions can lead to really dramatic impacts in the tail. So now we're starting to be able to incorporate that into our view of risk. We can do sensitivity testing that takes this information that comes from climate models and put it into our CAT modeling framework. That being said, we also need to make sure that we don't go off the rails and go beyond what the science says. You know, we're very commonly asked things like, okay, well, what would be the impact of hurricane frequency to your future business in 2030 or in 2050? And, you know, at the end of the day, that science is still really unsettled. Going and chasing areas of science where it's not settled is not cost-free. We need to make sure that we chase climate science impacts where they're robust and where they're happening in the near term, and use those further out scenarios for exploratory purposes, but don't lock ourselves into a situation that could lead us to sort of a maladaptive outcome. Thanks.
So this is kind of leading me to think about some follow-up things. Like, if you think about some of the different perils that are going to be impacted by climate change, you've got flood, right? So sea level rise, it's not really all that hard, as you said, to say if the sea level goes up, then that means it's like tricking the models to think the elevation is going down. So it's elevation is already baked into the models, so that's not that hard. But and then I guess if you're modeling heat, that's a pretty straightforward thing. But I think it's risks like hurricane, where you don't actually know whether future climate change will make hurricanes more frequent or not. I think we know they're going to be more severe, right?
So the way that we like to think about this at Liberty is to take apart the pieces of our different types of hazards, like hurricane, and look at some areas where the science is really clear, some areas where maybe the science isn't clear, but the impacts are large, and focus on where we can say something material that is impactful to the losses for our business. So, you know, like I said, sea level rise is very uncertain out in like the 2100 range, but within the next 10 years, we have a pretty good idea of what sea level is going to look like. So we can do modeling that incorporates not only the increase in depth of storm surge, but also the increase in the inland footprint of storm surges, which contributes materially to the increase in losses of those events.
Mm-hmm.
We also, you know, the frequency piece is rather uncertain, but where the science is a little bit clearer is that the proportion of our most intense events, so once you get a hurricane, the likelihood that it gets really severe to a Cat 4 or Cat 5 does seem to be increased, and that seems to be relatively clear. For our for the purposes of understanding hurricane risk, that's actually where the action is, because it turns out if you look back through the last century of US landfalls, even though Cat 4 and above storms only make up about 10% of US landfalls, they actually produce about 50% of our losses. So understanding that tiny fraction of storms can tell you a ton about your overall risk profile that comes out of hurricane. So instead of just saying, are we going to have more hurricanes or fewer, by breaking hurricanes up into their component parts, we can understand where the science is strong, where the loss impacts are material, and use that to influence our decision-making across the business.
So that's really helpful. I think a lot of regulators are kind of struggling with the catastrophe models and how they play into the rate making. I get the feeling that for hurricane, most states have kind of figured out how to regulate the hurricane models, informing the rates. But then for wildfire and flood, it's a lot less settled how regulators are going to look at these things. Patty, I guess.
Yeah, or just one comment. Just one comment on that. That particular point is in California, there are restrictions on using, for example, wildfire models and setting homeowner rates, and a lot of that's driven by real suspicion of the models, that they can be gamed, that they're black boxes, and various constituencies have opposed them being used because they don't. It's just introduces a lot of uncertainty. So I think moving forward, models are incredibly central to insurance pricing and the availability of coverage. And moving forward, I think we need to figure out a way to be able to better communicate or make those models more transparent, to be able to build more trust in those types of models. And I think it's difficult to do, but I think that's a direction that's needed.
It's actually interesting that you bring up the whole black box concept. I have a theory that the word black box, it means I'm not allowed to look inside, or when I look inside, I don't understand what I see. It doesn't mean that nobody understands it, or that nobody's allowed to look inside it. And so, I mean, most states have provisions, or at least could create provisions, to protect the IP of the catastrophe modelers, so that their competition would not be able to instantaneously access tens of millions of dollars of research and use it, to their disadvantage, which I think is a legitimate concern for entities that are, that have invested private money to create something for use in a market. But what do you think about
we learned after Hurricane Andrew, when more than a dozen insurance companies, depending on who's counting, went out of business, that just fitting a curve through historical losses when you're talking about the most extreme events doesn't work. And that's even before we start to talk about climate change. Mm-hmm. When you are managing to the biggest, ugliest natural disasters that we have to deal with as a society, you have to use the best available science. That's just all there is to it.
Well, and on that, being a California resident, and Lloyd's example of California requiring a backwards looking historical approach to rate making, out of the last, the 10 most destructive fires in California history, 8 of them have happened since 2017. 6 of them have happened in the last 12 months. So what curve could go back in time, stopping with data through 2016, 2017, or even last year? What data could have predicted that 6 of the worst 10 fires in California history would have happened in a 12-month time span? And we're only in mid-August. The fire season just really started for us. So I think that it's just self-evident that we're going to need to do things that are more complex, and the boxes might be complex to in order to do this properly. And as Kelly said, the science is not all that well established for how to bake into climate change, but that doesn't mean it's not the right way to go. I mean, you can tell I'm sort of opinionated on this, but it feels to me like stifling science and innovation in an attempt to keep premiums down is a misdirection. To pretend that the risk is less than it is, it doesn't actually help people. It temporarily seems to help people, but I don't think that in the end, pretending that their risk is the way that it used to be 20 years ago, it is ultimately useful. Patty, do you have observations on this?
Well, I have a lot of thoughts based on my research as to insurers being given the flexibility to respond to changing risks or their anticipation of increasing risk, being able to charge an actuarially fair premium. And the research I've conducted on the property and casualty insurance market, especially on the homeowners market in the US, suggests insurers respond to catastrophic events. They respond to their own loss ratios, bad underwriting performance, and they respond to bad underwriting performance in a state where other insurers have been affected And when I say respond, they often are looking for some kind of tool to better bear the risk, or they want to just leave the market altogether. Of course, what we're looking for in my research are those strategies that allow insurers to stay in the market. And they have other tools besides the price, right? So just to put those out on the table, we should keep in mind that insurers do have the ability to increase capacity. If they want to hold more capital, they can employ the use of reinsurance to some extent. Over time, there's a lot of fluctuation in availability and affordability of the reinsurance for insurers. And there's new growing alternative risk transfer mechanisms out there. Insurers also can just naturally diversify in ways by underwriting in other types of coverage or geographically diversifying across other areas. But what I think is really important, what we're getting to here, is the idea that the insurer needs to be able to price the coverage in something that's actuarially fair, because in the short term, they may be able to subsidize coverage across other lines of business or subsidize losses. But in the end, the market gets very distorted if the price that's being charged to different risks is not really reflecting those risks. Go ahead.
So that really plays into the concept of availability as well. You can measure the risk as Kelly presented to us, and then you can charge as an insurer what you think is the cost of the risk transfer, which actually is what actuarial standards of practice say that rate making should be about. Is that how you see things playing out with respect to climate change?
I think what I'm looking at with the whole rate filing process is that there tends to be a lot of variation across states and over time in how rate requests come in, the increases that are being requested by insurers, and how the regulatory environments are handling those requests in terms of how long it's taking for them to review them and approve, as well as whether they're actually approving the amount that's actually indicated, or they're approving typically a lower amount than what is actuarially shown. So that's kind of concerning. But I think there's a lot to learn from the states where there seems to be a pretty smooth process. Insurers are getting rate filings approved and the market seems to be stable, versus other states that may have a different rate regulatory regime that's imposing more costs and maybe contributing to the disruption. So for instance, in California, just last year, 2019, 76 rate filings came in, and the median time to approval for these, and these are prior approval based filings, was 199 days. So it's a long time for the insurer to have to think about what to do after the request goes in, whether to continue to write coverage at an inadequate rate, pause on issuing any new coverage, deny any renewals, or not renew certain policies. That is a concern in a state like California, where especially with wildfires, we're seeing an increase in risk. A counterpart to that is South Carolina, that has been affected by some hurricanes. In 2019, they had 44 filings come in, but the median time to approval was only 18 days. So significantly less time spent. Now, this could be a sign of how complicated the filings have become, and regulators need to understand how to read these filings and be efficient in processing them. But they do suggest a problem insurers might have in being able to get to an adequate rate. So if the current rate is not adequate, and the risk suggests they need an increase, and they have to wait through some onerous process to get that, we're just making things worse.
Well, I actually, I hate to say it, but I don't think 109 days is really all that long. I mean, we've got experience with filings that take over a year, and in some of the tougher states. But I mean, to your point, more certainty around regulations certainly seems to help availability. we've got a private flood product we're trying to roll out, which isn't even a rate change. It's a new program, and it's in states that are very much in need of private flood alternatives to the National Flood Insurance Program. And my observation is that the more that the rate filing is dependent on catastrophe models, the harder it is for the regulators to figure out what to do with it. And it's a tough situation for them. I don't necessarily fault them for taking a long time. They don't necessarily have the budget or the manpower to be able to review every single flood catastrophe model, every single hurricane model, every single wildfire model, and understand how the company is using it. So, I'd say I'd be kind of interested in the group's thoughts about that. I think there's probably going to be a pretty high correlation between the tough states and the tough catastrophe risks.
Yeah, I think it's important to keep in mind, though, that, we can't just chase climate risk from a rate side. That can't be the whole answer here, right? Because really the highest and best use of insurance is in mitigating risk. And sometimes mitigating risk means coming in after a disaster and supplying funds to help people rebuild their lives. But on the other hand, sometimes it's in helping to prevent those disasters from being so bad to begin with. To make sure that we have a sustainable, market going forward into the future, it can't just be continue to chase rates up as the hazard changes. You also have to think about risk mitigation on the front end. To me, the vision for where the insurance industry should go in the future should be to really lean into this risk advisory services, to be able to say, hey, by the way, did you know you're in a high risk wildfire zone? How about go and put some grates over your attic vents? Maybe a wood shingle roof isn't a great choice in this area. Things like that to help to mitigate that risk on the front end, to make sure that we're not just chasing the physical hazard, but working to do what we can to reduce that physical vulnerability. Because the problem is you need to actually protect communities' abilities to invest in protecting themselves. Because what can happen in situations where the physical hazard has started to run away from itself, and there's some evidence that this is maybe happening in a few coastal areas, is you start to impact property values, which means you start to impact property tax bases. So communities start losing their internal funding mechanism to protect themselves from future flood events or wildfires or whatever. Versus if you can get in there before your disasters have really started to accumulate and say, okay, let's protect this base of investment that you're going to need to use to protect yourself from climate risk for decades to come. If we can get in there and protect that property value base and the property tax base, that can help to make sure that those communities can mitigate that risk both now and in the long term. But there's a time value aspect here, which is that you can't wait until you've already started to cause those property value impacts. You need to make sure that those investments that we do now are actually worth more, because they protect our ability to invest in resilience in the future.
That's an excellent segue into the concept of affordability. And we have Brian Powell on. He's got an internet outage in his town, so he is here on the phone. And so, Brian, I'm hoping you have audio and hoping you can talk to us about how Alabama and the leadership of the insurance department in Alabama was able to muster up the science and the political will to help reduce hurricane risk in your state. So you're on mute right now, Brian, just in case you can't see the screen.
Okay, can you hear me now?
Yes, thank you.
Okay, perfect. Thanks for having me on today. Again, I'm Brian Powell. I'm with the Alabama Department of Insurance, and I'm the director of the Mitigation Resources Division and the founding director for a wind mitigation program we have here called Strengthen Alabama Homes. Alabama experienced a time where there was little, if any, homeowners insurance was available to its residents along the Gulf Coast due to the increase of climate risk. The work that we're doing here at the Department of Insurance is encouraging insurers to remain in the market, making the market more attractive to new carriers that want to write in Alabama. and we're talking about homeowners insurance policies, and more particularly wind policies. That's been our biggest challenge along the coast. But having new carriers and carriers, existing carriers stay in the market, creates a healthy competition, which is exactly what we want to do. Under the authority of the Alabama legislature, the Strengthened Alabama Homes program was created and assigned to the Department of Insurance. Want to give you just a little bit of history on how this program came about and exactly what it is. So I'm going to try and to attempt to paint a picture of what the state was faced with as far as an insurance market back prior to the creation of the Strengthened Alabama Homes program. Looking at the insurance market between 1998 and 2011, insured catastrophe losses across Alabama totaled about $8.5 billion, with homeowners and renters insurance accounting for about 67% of those losses. 2011 was the worst year in Alabama history for catastrophe losses, with homeowners losses representing about 66% of the $3.2 billion in cat losses. This record of catastrophes took its toll on the state insurers, obviously. The return of net worth for the Alabama homeowners insurance market from about 2009 averaged a negative 7.9%, which ranked Alabama about 43rd out of the 50 states. If we included the tornado outbreak in 2011, and I'm sure you guys remember that from the news, it would have made Alabama the least profitable state in the nation. Taking into account Alabama's largest geographical area for cat exposure, the coastal areas on the Gulf of Mexico, and by the way, it's very small. It's only about 53 miles of coastline. The total value of insured coastal exposure is around $100 billion, but that's roughly 15% of all insured exposures in the state. And this is a very interesting statistic here, is of the $100 billion in exposure, about 50% of that is residential exposure. So between 1998 and around 2001, nearly 3/4, so almost 775,000 claims of catastrophe claims paid were for damage to existing homes. The value of the claims paid for homes was about 66% of the total payout for claims, which is almost $6 billion in 2011. Just wanted to see what that would look like in today's money, being that it's only 10 years ago, and it's about $7.3 billion. Historically in Alabama, up until 2011, there were a little over 2,000 federal disaster declarations, and Alabama up to that point was seeing on average about 34 disaster declarations in a year. So you see how this picture is being painted for our risk exposure to these severe storms. Between 2000 and 2010, we averaged about 59 tornadoes a year. In 2011 alone, the tornado outbreak that I mentioned earlier was number 6 in the top 16 most costly world insurance losses between 1970 and 2011. So due to continuing repetitive losses, primarily because of increasing catastrophic storms, and these are storms that were increasing in frequency and severity on our Gulf Coast, and the increase in tornadic activity on the coast and inland, insurers began reducing their exposure by reducing the number of policies they were carrying, and they basically stopped writing business on the coast where their largest exposure existed. A lot of carriers eventually withdrew from the market, which made little, if any, insurance for homeowners available in the coastal area of Alabama. So you can imagine that any insurance you could find was very expensive. We started seeing grassroots movement and consumer concerns pop up everywhere, and they started prompting lawmakers to act to solve that insurance crisis on the Gulf Coast. So by reducing loss of insured assets, you reduce payouts, right? So reducing the loss of homes became the primary intent of any legislation that was going to come out of this uprising, basically of interest on the coast. In 2013, legislation was passed that established a storm mitigation program and basically a treasury fund. And I'll have to add, there was no funding mechanism attached to that. And they assigned it to the Alabama Department of Insurance. I was assigned by the commissioner at the time to lead the establishment of a mitigation program in late 2013. and to work under the authority of the legislature to develop a solution for this problem. My team and I carefully researched options to create a sustainable program that would reduce the risk of repetitive losses from hurricanes along the coast of Alabama. From that research, the Strengthen Alabama Homes was actually developed. And around here, we refer to Strengthen Alabama Homes as SAH, so I'm going to say SAH instead of Strengthen Alabama Homes. We have to say that about 1,000 times a day. So SAH is a wind mitigation grant program that follows the Insurance Institute for Business and Home Safety Fortified Standard. If you're not familiar with the Fortified Standard in IBHS, it is a building standard that exceeds most building codes that are in existence. It takes a holistic systems approach to protecting your home against catastrophic wind and against hail. SAH issues grants to Alabama homeowners in the amount up to $10,000 per home to fortify their home, and the funding for this program comes from a portion of the fees that the Department of Insurance collects from the industry. The use of these funds are totally supported by the industry because it goes back into risk reduction within the market. Additionally, as an incentive, we passed legislation, I think it was back in 2015 perhaps, that mandated an insurance discount to be given by admitted carriers if the homeowner achieves a fortified designation. And this legislation was supported by the insurance industry, and it passes the savings on exposure onto their consumers. Subsequently, insurers, due to the reduction of their exposure and costs associated with these reduced exposures, are able to negotiate more favorable reinsurance rates. The premium reduction realized by the homeowners is on the wind portion of their policy. So imagine those that are building houses or own houses on the beach who have the most exposure. That wind premium is about 80% of the overall premium to insure their home. And this discount can reduce that premium by as much as 50%. So if you fortify to the highest level of the IBHS fortified standard, you can receive almost a 50% reduction in your overall premium. To date, the Strengthen Alabama Homes program has fortified about 3,200 homes. But what we've actually done with this is not just the number of homes that we've fortified, but we've developed strong partnerships, partners along the coast such as city and county government offices, different grassroots organizations, nonprofit organizations such as Habitat for Humanity, and most importantly, we have engaged the private sector. This strong message is really benefiting taking the fortified program forward. SAH has become a sounding board for this effort for pre-disaster mitigation. And has been very, very successful. And that's shown here in the numbers. Today in the United States, there are just under 30,000 homes in the U.S. mitigated to the fortified standard. But of those 30,000, there are 25,000 in Alabama. And the majority of those are on the coast. I would say probably less than 500 exist north of the coastal areas in Alabama. So Alabama clearly leads the nation in the number of the fortified homes that exist. And over the past couple of years, we've seen a tremendous growth in the insurance market. We've also seen a tremendous impact to Alabama's economy. To date, looking at the measurements we have for Alabama's economy, because of SAH's contribution, is we've seen about a $53 million increase in economic activity, and also about $34 million additional in GDP to Alabama. And we've created, calculations show that we've created a well over 500 jobs in Alabama because of this pre-disaster mitigation program. So SAH has made a positive impact on the insurance industry, and it also has promoted the affordability of insurance by reducing the risk, and it helps to create a sustainable insurance market in Alabama.
Well, Brian, that is super impressive. And I don't think you can see the chat because of the internet problems, but we've got a request to share a link to the legislation. So if you'll email it to us or to Carolyn, we'll try to post it in the chat while we're still on today.
Sure, be happy to do that.
That's actually super impressive. And I will say, it feels to me like risk reduction is the only strategy that everybody should agree is good. Like it brings down the risk of people losing their homes or their lives in the first place, and brings down their insurance premiums. It helps the insurance companies manage the risk better. I mean, it feels like a win all around. And so I guess one question, maybe Lloyd, if you could speak to, like, why isn't everybody running around mitigating right now? I mean, what's holding us back?
Right. Well, just one observation about the mitigation is that that climate change creates more of a challenge. Is that when you're doing that cost effectiveness analysis for the mitigation, are the benefits or of the mitigation worth the cost? You really have to look into a changing world in the future, so that the risks are changing. And so I think I don't think that's I'm just raising that as an issue, that when we do this, we should not only look at the cost effectiveness over the next 5 years, but over the next 30 years, and see how those programs play out. So I think that's one issue to address here. And then the other issue is the whole issue of who's paying for the mitigation. What kind of I call them wealth transfers in this case. If the assessment is in all properties in Alabama, there's definitely issues will arise of opposition to having those benefits of particular areas. So I think those are two issues that need to be thought about in the mitigation. Yeah, great stuff, but in the context of climate change, those are two issues that I think are important. You're on mute, Nancy.
Sorry. Along those lines, Brian, we did get a request. Do we know, like, how socioeconomic diversity of the homes played out in the Strengthen Alabama homes? I mean, my observation is the poorer communities have fewer resources to help themselves, and often those are the ones that are on the front lines of catastrophic risk and climate change. And so there's a real question about how to get the resources and the data and the knowledge into the communities that need them the most.
Yes, and that's actually one of my favorite topics to talk about.
Okay.
One of the things that we did with the Strengthen Alabama Homes program is we did not induce some type of means test for income to qualify for grants. There's no cap on income. The only thing that we have that's really our restrictive piece is that the home that you want to mitigate has to meet a minimum standard that IBHS sets for their fortified program. So if the house is not going to withstand a storm, even with the mitigation piece, and the biggest part to look at is the foundation of the home. If it meets the fortified standard for moving forward with the fortified program, then we move forward, regardless of location, regardless of income, regardless of any other factor that may be involved with that applicant. There's been issues where we've gone into areas, and one of the areas that's one of my favorite areas to talk about, and one of my favorite areas to work in, because I actually hold a special place for the people that live there, is in the Africatown community. This is a community that has been economically depressed for a very long time. The houses needed a massive amount of repairs to some of them, but they were still being occupied. And also because of the condition of the homes were uninsurable. So we partnered with a local grassroots organization that does a lot of work in that community. We also partnered with Habitat for Humanity. We partnered with Home Depot. We partnered with several other entities, and we were able to go into that area and do repairs free of charge for the homeowners, based on volunteer labor and then also volunteer materials to do a lot of the repairs. Some of them were structural repairs to the home. They even repaired some of the electrical and plumbing and things of the home. And then by having the home in that state, we were able to go in and actually do the fortification piece. So once all of this was done, then the house became attractive to insurers because it was a good risk. And because of the work that we were doing in those particular areas, and there were several of them, by the way, that insurers were able to come in and start writing business in areas where they previously couldn't. So that's a success story that I'm proud to tell at any moment. But we do see diversity in all across the board in all counties that we're doing work in with Strengthen Alabama Homes.
Thanks, Brian. I'm glad you had such a positive answer to that. Lloyd, I guess I'm wondering if you have more observations on how to balance the conflicts between availability and affordability and some of the policy dynamics to navigate between insurers and the social perspective.
Yeah, sure. Yeah, so I think, you know, the theme of what we're talking about today is, you know, the challenges climate change creates for insurance markets. So, you know, one challenge is that things are changing, you know, things are changing over time, and that creates its own challenges. And then second, you know, risks are getting worse, which creates its challenges. And so let me talk a little bit about, you know, some of the dynamics that arise from that. But first, you know, I also want to say that climate change creates challenges for the insurance markets, but it also, you know, I think creates opportunities. You know, insurance is becoming ever more relevant. You know, fundamentally, insurance is a welfare improving product that, you know, smooths outcomes over different states in the world, and that's becoming more relevant as you know, we see more often negative events or adverse events, and they have a greater impact. So I do think climate change also provides an opportunity for the insurance markets to you know, play a role in our society. But regarding the sort of challenges created by you know, the changes in risk or increases in risks, take for example, you know, sea level rise. So, you know, sea level rise is going to cause risk to increase gradually over time. You know, so we've heard that you know, from Kelly, and we're going to, you know, see that. And so people, when people purchase a home, and then there's they'll see gradually that their insurance rates are going to go up over time, and that creates you know, lots of discontent and complaints, and so you get a situation there where there's lots of pressure against moving to risk-based rates, because you know, there's a situation where the risks are changing, premiums are increasing, and so you'll get opposition to moving to risk-based rates. And you know, we see that in the current you know, issues around NFIP's risk rating 2.0, and we also saw it definitely with the Bigger Waters Act, you know, back in the early 2010s. So, and then another aspect of that you'll see in the NFIP in particular is the push for grandfathering, which means that your rate would be based on a past elevation or past sea level. So one of the ways to, you know, deal with that is that, you know, the Congress is considering, and that, you know, we've helped try to flesh out our affordability program. So, you know, that having some kind of affordability program for households that you know, are most impacted by increasing rates, you know, can you know, take some of the pressure off, and, you know, allow a transition, or allow us to reduce the political opposition to risk-based rates. And one of the, you know, in designing these affordability programs, I think it's you know, really important to figure out a way to, you know, effectively target them. You know, you don't want to have the rates, you know, wealthy households, they don't need to be subsidized or by an affordability program, and, you know, we want them to be able to pay risk-based rates. But designing a program that focuses on the most vulnerable households is, you know, I think, you know, we're seeing a number of different proposals along those lines, and, you know, I think that's an important way to go. The other aspect of that is, I think, is making those programs transitory. You know, you don't want to bake in a subsidy forever on a property. You might only want to restrict it, or I think there's a lot to be said for restricting it to the current residents of a property. So that's another aspects. And, you know, but even then there's with an affordability program that's restricted to certain current residents, you're going to have some you know, welfare loss due to these rising rates, so that you know, when a person sells the property, even if they had been subsidized, that you know, that would result in a lower price to the buyer than they would have otherwise. So that's on the affordability. Let me just bring up one more, you know, I know we're getting short on time, but one more area that I think is important to look at is that the climate change provides a lot of opportunities for some of the innovative insurance instruments we're seeing proposed, the parametric coverages, as well as the community-based insurance ideas that Martian and others have been, you know, a good article on, or a good paper on that recently. And those are, you know, important innovations. But, you know, something to be considered is how those products interact with the, you know, what I'll call the social insurance programs we have in this country, in particular the FEMA's public assistance programs. And when you're trying to make those programs attractive or sell them to local counties and cities and localities, the first question is going to be asked is, you know, how's that going to affect my FEMA assistance? And so, you know, without going into that right now, I think there's a lot to be done to improve that incentive structure so that those types of products, you know, are more attractive to cities, and they don't have to worry that they know how it's going to affect their FEMA assistance program. So so the point being that interaction between the public and private, or the social and private insurance, I think is increasingly important moving forward.
Well, thank you, Lloyd. And I think you're giving us a good entree to one of the questions that we got in the chat, which I think maybe Kelly and Patty might have some thoughts on, and that's from a policy response standpoint. Is there an informational aspect? Is there anything that government could do to mandate better, more standardized reporting regimes or better disclosures that would support mitigation, supporting economic activity? Kelly, you want to take the first stab at that?
So, you know, I actually think it relates pretty closely to there are a couple other questions related to data and data access and what don't we know that are in the Q&A. So I'm going to kind of bucket all of those together, which is that to be able to understand climate risks, it requires us to ante up to the table a little bit more on data, because, you know, in the old days, if you're looking at hurricane risk and you don't have a lot of information about a property and it's accidentally a mile down the road, you don't get the location right or something like that, it's not going to make a big difference in your risk profile. Your hurricane risk doesn't vary that much spatially. But for the risks that are changing really rapidly related to climate change, particularly water-related risks associated with flooding and to a lesser extent wildfire, if you have a location that is off by 30 feet, and instead of being on the building, you're in the ditch next to the road, you're going to get a fundamentally different view of the hazard. I like to say that flood is where you find out where your data bodies are buried. That's how you know the quality of your exposure data. So insurers who understand that and who know that you need to have just a much better view of an understanding of where your risks are and what their risk looks like are going to really set themselves apart in the climate change environment, because those really rapidly changing risks are the ones that require more of us as an insurer. So that's what we have to be able to bring to the table is, you know, advanced spatial analytics. We're using machine learning to understand where rooftops are within parcels. There are things that you could get away with from a catastrophe model from 30 years ago that do not work in the era of climate change. People have to be able to bring better data to the table, and that's something that we are really focused on at Liberty.
And it's not just, you know, the position of the houses, but changing conditions. Like if for flood, if you you know, create a concrete, you know, area where the water has nowhere to go, that changes everything. For wildfire, if your vegetation changes like in a couple of years, that changes everything. And so keeping up with all that data, it's expensive. I actually think that there has to be data collection that's not just funded by individual insurance companies. Because if you're looking at risks like flood, like fire that are contagious, like my insurance company needs to know about all the risks on my street and maybe even like in a half-mile radius around my house. So I think there's a lot more to be done.
Yeah, I think that includes land use, and it really includes climate hazard as well. I will say that there's a lot of venture capital money that has gone into the climate data analytics space, and maybe not quite enough expertise to go around. We're really looking at trying to understand climate risk by partnering with others who are as interested in investing in their science teams as we are. So understanding the physical hazard. But I will tell you, there are a lot of fly-by-night operations out there that are happy to tell you, at incredibly small spatial scales, what your climate risk is going to be 50 and 100 years into the future, that are well beyond where the climate science actually lies, based on the lack of understanding of what climate models are actually able to tell you. You can go and buy products out there today that look like that. If we don't vet climate data with the same rigor that we bring to catastrophe models, we're going to make inappropriate decisions about our risks. So that is something that we as an industry are going to have to grapple with, to be able to bring that expertise to the table, to be able to sort the wheat from the chaff and what's out there in climate hazard analytics.
Yeah, I definitely think there's a role for the insurance industry and possibly state insurance regulators to have a catastrophe model clearinghouse and be able to start standardizing information and standardizing a certain level of rigor of review, and making those models more understandable without letting their IP out into the world. I guess, for Patty's research, do you see like any better outcomes in states that are more sophisticated with respect to understanding the data and the hazard and the insurance rates, or any comments on that?
I haven't really been able to identify specific activities around the CAT modeling and the use of the model output by regulators. But my thoughts on that is just that, in addition to sharing more about what the models are like, what you can get from the models, these programs like what we heard about from Brian about Alabama, what those programs are doing, the outcomes of those, that needs to be shared across other states. And we need to understand the extent that certain types of programs that might be addressing something like the hurricane risk, what elements of the program might be useful when we're also looking at flood risk or the wildfire risk. There's a call for more research, I think, to really pin down the lessons we can learn from things that are working, where the insurance markets have been the most stable. What kind of activities have the regulators taken to encourage entry or to keep insurers from leaving the market? I think that's all very important pieces of this. Although I have to say I'm very encouraged by the focus on mitigation as well. I think that's just really important for us to walk away with today.
And I'm happy that we get to see Brian. I'm glad your internet came back. We just got a nice comment in. The NAIC is rewriting their CAT model handbook. I've actually had been invited to help them work on that, and I think that's a great piece of information. They're trying to figure out how regulators are using the old version of the handbook, which was updated 10 years ago. And so I'd say that the understanding the current risk is key to understanding the future risk and understanding how to reduce the future risk. So it's all part of the same thing, and keeping the insurance industry together. Any parting thoughts from you all before we say goodbye to our audience? Brian, since you got to show up as like a guest star at the end of the the video.
No, just thank you for your time today, and thank you for having me on. And I'm going to post in the chat a link to reach the Strengthen Alabama Homes legislation. So take a look at that in just a few.
And thank you. I'm going to put my email address in there to anyone who wants to follow up on any of the things we talked about. Feel free to reach out to me. I do want to say once again, for the Wharton Risk Center, this is a very important topic to all of us, whether we know it or not. And y'all are doing great research. I feel very privileged to be here today with Patty, Lloyd, Brian, and Kelly, and just want to thank everyone who attended. Really appreciate your great questions today too. So have a good rest of the week, everybody.